This is our Forex blog for October 12th, 2011. And like most days, we want to focus on the currencies that are trending one way and buy the strongest versus the weakest and sell the weakest versus the strongest. Clearly today, you can see the dollar and the yen, which we compare the real-time strength versus each other currency. This is made up of 5 different statistical trend tools we've developed over the last 8 years. 3 of them measure the direction the dollar is going, and 1 of them measures the intermediate time frame intensity of the direction, and the last one measures the bar by bar intensity. So anytime you see a currency like the dollar at and above the dotted 80 level, it means the vast majority of dollar pairs are going down, and they're going down with a lot of intensity. This is pretty much a no-brainer today, because what you're looking for is extreme weakness, especially when most of the longer time frame trends are down, followed by if you miss that first move, then the next counter trend move, you want to see less strength, and that means it's likely that that previous weakness will return, which you can see it did for about a half an hour. Just about 10 minutes of just mild strength, an hour of weakness, 20 minutes of mild strength for the most part, hour of weakness. Here at 3 to 3:30, there's no strength at all in the dollar. And so you'd want to trade that against one of the stronger pairs. Today, the Australian is, without a doubt the strongest one. The euro was pretty strong from 1 until about 4. So basically, you'd want to be trading the Australian by buying the Australian dollar, buying the Australian yen, and for the most part buying the euro dollar and euro yen until about maybe 6 or 5:45 when extreme strength came in. Here's the Australian dollar from 1 to 5. Notice the currency. It just absolutely explodes up. And when you get above or upper containment band, usually markets can stall out. It becomes a little risky to buy above the upper containment band. At least wait for a 2 or 3 hour sideways range or some kind of a pullback before you get in and get in. But you can see this thing shot up about 150 pips. Let's look at the individual charts that we have that have the Australian on it. These are our range charts, and this is a 6 pips per bar Australian dollar chart, and it makes it really easy to trade. At 1 o'clock, when this went from below to above the hourly, you can see it went up. You bought that pullback right here. This is our new intelligent trailing stops. You would have got in here at 99.66 and out right here with almost 80 pips of profit. It didn't really even pull back that much at all. You got back in again here at 49, and notice our trailing stop is very, very tight. We know how strong this currency is, and when it gets above the upper containment band, we tighten the stop. It's a very intelligent trailing stop that's unlike anything else you'll find in other platforms. It's based on the chandelier trailing stop, where it uses a certain multiple of volatility, but we adjust that multiple based on how strong or weak the market is. If weakness came in, we tighten the stop. If the strength lessens, we tighten the stop. If the market moves statistically too far and thus is more likely to reverse, we tighten the stop. And you can see this last trade right here, in around 50. It's still in, and we're out right here at 30. It's an 80 pip move, and it kept you in it. And at no time was the stop tighter or wider than 12 pips for the most part. And after you wait for a deeper pullback, let's say you went long here at 17, you're out here at 28 for a small profit. The deeper the pullback, the better. I wouldn't buy such a shallow pullback, or if you do, get into it after 3 or 4 bar red bars down, you go long a pip above here, and that way you have a tighter stop. I just want to showcase how it looks on a range chart. Now the euro also was quite strong from 1 to 5, and you could also have traded this on the range chart as well. Let's look at this. Euro dollar. In this currency, when it was underneath the hourly, it's more likely to go down. When it kind of comes up to the hourly and chops around and breaks out, you could go long right here at 39, out here at 56, If you take every single trade, you had two small little 6 pip losses here, and then it got in here at 57, and it stayed in the trade all the way up here until 61. So when you find these strong trends, this is one of the tightest stops you'll ever find, but we're allowed to have a tight stop because of the sophistication that goes into this stop. It uses our statistical trend tools, and it will keep you into the trade. Has just wide enough stop not to let the noise of the market get you stopped out, but as soon as the market moves too much, like in this case, it went above the upper containment band, we tighten the stop dramatically, so you lock in almost every pip. The New Zealand was also strong today, and the euro could have also been traded against the yen as well. Here's the euro yen. I'm going to go forward here on the chart. This was yesterday. You can see again from 1 o'clock, this just trended up. You buy the little pullbacks, you made money, and again when it gets above the upper containment band, you're usually better off waiting for an hour and a half, 2 hours of sideways consolidation or some kind of a pullback. I wouldn't, in other words, buy this breakout right here. You wait for a little pullback in a little sideways range. You buy this, and you can see it shot up. And this is our IntelliStop using 5-minute bar data. If you're a little bit longer term trader, this one also keeps you into the trade, for the majority of the profits.